Okay, just checking, can you hear me okay?
Yes.
Yes, we can hear you.
Okay, wonderful. Okay, we starting the meeting. We start recording now. I have a bit of a feedback on my system, just hold a moment. Okay. Okay, welcome to this session. I'm sorry about this starting a bit late, but I had everything set up, and at 6 o'clock the power went out, and I had to try and reconnect everything again. Okay, so we're going to be looking at some recapping on the main elements of the components of the financial statements. We're going to explain the difference between gross profit, net profit, cash on hand, which we've done before. And then we're going to look at applying profitability and liquidity ratios to a set of financial statements using these tools. Okay. So you need to have your textbook with you, because we're going to be doing some work in your textbook. Okay, so just a recap on the previous week. The purpose of accounting. The purpose of accounting is to provide financial information so that people can make informed decisions. Okay. Can no one hear me? But someone saying they can't hear me. Can the others hear me?
Yes, I can hear you.
So if you can't hear me, I suggest you just reboot or something. Because then the problem is on your side, not my side. Okay, so we said, okay, to recap, we are, purpose of accounting is to provide financial figures so people can make informed decisions. From financial management differs because it's got, we don't just report, we manage the finances in terms of investment decisions, financing decisions, and cash flow decision. Short-term financing, debtors, creditors, etc. Okay. There's just some financial statements. By now you should be familiar with those. Okay, we looked last week at gross profit, which is your sales less cost of sales. Your net profit is all your income minus all expenses. So let's look financial analysis, because that's really what we are talking about tonight, is to look at the financial analysis. Now, let's recap. We're looking at assets. The assets are the resources owned by the company and controlled by the company from past events from which future benefits will flow. Liabilities, on the other hand, are commitments from the company from past events which will lead to an outflow of economic benefits. The income, that is your revenue you get from your activities. Expenses, that is your day-to-day expenses plus your purchases of your stock, cost of sales. Capital, that's the money the owners put into the business. Drawings, that is the money the owners put into the business. So let's have a look again, just in more detail. We've got assets. Assets get split into non-current assets and current assets. The non-current assets are those assets with a lifespan more than 1 year. So typically, you will have your property, plant, and equipment, vehicles, furniture, computer equipment. All those are in there. Then you also have things that are financial assets, such as investments. And then we have intangible assets, such as patents. The current assets, these are assets with a lifespan less than 1 year. We have typically cash, that's your money in your bank, your debtors or accounts receivable. Let's see what I can do. Is that better?
Yes, I think it sounds better.
Okay, great. Yeah, because I don't know what was happening here because it was echoing in my ear as well. Okay, so the current assets, we got cash, our debtors, that's our account receivables, people that owe us money. And then we have stock or inventory. Remember, we use the terms interchangeably, stock or inventory. Then we have liabilities, that's the obligation of the firm to pay. Then we have non-current liabilities, those are obligations more than 1 year. So typical under your non-current liabilities is your long-term loans and bonds over your property. Then we have current liabilities. Those are liabilities payable within 1 year. Typically, it's your bank overdraft and your creditors. Creditors, that's your accounts payable, people that you purchase from, your suppliers, and you have to pay them back. Okay, then we have owner's equity. Owner's equity is your capital contribution less your drawings plus your profit. So your net profit that you make is your income less expenses, typical income that you have. If you are a trading organization, you have sales. Your service organization, you have fees earned. Then you can have things like rent received and interest received. Okay, so those are other typical income that you can have. Expenses, amount spent during normal operations. Okay, you have your things like rent paid, interest paid, advertising, salaries. Okay, so those are your typical expenses. Okay, so that activity that is from past okay, we had a look at those. I don't know if you want to go to page 23 and just have a look at those. So they ask us to look at those expenses on page 23, activity 2C, and see which ones of those are operating expenses. Okay, so I'm going to give you a couple of minutes just to see if you can identify the operating activities, and then I will run you through the various accounts so that and to tell you where they belong. Okay, so I'm going to give you a minute or 5, and if you can have a look at that, thanks. Okay, I don't know if you've had enough time, but let's have a look at those. If we look at list wages and salaries, yes, that's an operating expense. Input and output VAT, that goes to a control account. It's not really part of your assets or liabilities. Insurance, that will be an operating expense. Trade payables, that's a current liability. Repairs and maintenance, that would be an operating expense. Sales returns, that's a negative income. Water, electricity, that's an operating expense. Interest on fixed deposit, that's not an operating expense, that is an expense, but not an operating expense. Taxation expense is also not an operating expense, it's an expense after operations. Advertising would be an operating expense. Telephone is an operating expense. Trade receivables is a current asset. Credit losses, your bad debts, that is an operating expense. Cost of sales, it's an expense, but not an operating expense. Stationery, that's an operating expense. Okay, so those are the different expenses. So we've had a look at the different, just to look at them again. Assets, the resource, there will be an inflow of future benefits. Liabilities, the obligation, there will be outflow of benefits. Income, increase in benefits. Expenses, decrease in benefits. Capital, that's money coming into the business, and drawings, money going out. So we have done this in the previous week, activity 2D. And then we're going to just look at interest. Interest is the money that you pay the cost of borrowing. Okay. If you borrow money from the bank, you must pay interest on it. So interest is equal to the principal times rate times the time. So what does that mean? If you borrow, try and draw this thing here is equal. Okay, if you borrowed 1,000 rand. Let me just clear that. There's your 1,000 rand. And at 10% interest, which is 0.1 times 3. Let's say you borrowed over 3 years. Okay, that's 10% of 1,000 is 100 times 3. So that'll give you interest that you have to pay over the 3 years is 300. Okay, now if we're talking about if you borrow money for a part of a year, okay, so let's say you borrow it for 6 months. So you're going to do the same calculation, but then it would be 6 over 12 to say it's for half a year. So that's the basic calculation for interest that we have to pay. Okay, you can have a look at this activity, but I want to get to the ratios. Okay, so when we talk about ratios, when we analyze a company's performance, there are a couple of ways of doing it, but we talk about financial ratios. So it is calculations that we do to see if the company is performing well, the profit they're making is okay, etc. Now, if you do a calculation, so for example, if I say I made a 10% net profit in my company, now we have to be able to say, is that good or bad, and what the implication is of that. Now, simply saying I made a 10% profit, on its own means nothing. Because if you say my 10% profit, if I have to ask you, is it good or bad? Can't really say, because you have to compare it to something. So we can either compare it to a previous year. Okay, so what we do in a ratio analysis, we look at the previous year's performance of the company. So let's say it's 10% this year, and last year was 15, and then was 20% the year before. Then I can say, yes, it's a negative trend. It's going down from 20 to 15 to 10. And that's a bad trend. But if we only made 2% last year, and we now make 10% this year, then it means the company is performing well. Similarly, if you say the company is making 10%, we can also compare it to the industry or to other companies. So if we then say other companies are making 15%, then we can say, okay, we are not doing well. We are below the other companies, and we are not performing well. So any ratio that we have, you must compare to something, and then you can make a judgment whether it's a good ratio or a bad ratio. So let's have a look at the various ratios. The one ratio that we have is our gross profitability ratios. We have at the moment, we're going to look at profitability ratios and liquidity ratios. Now, there are many different ratios that you can look at in financial management. And I've never seen an exhaustive list, because every textbook you take has one or two new ratios that they add to it. So if we look at the profitability ratios, the first one we look at is our gross profit percentage. So remember how we get our gross profit. We get our sales less our cost of sales is equal to gross profit. So for gross profit percentage, you will go to your income statement. You'll take your gross profit amount. You're going to divide it by your total sales times 100, and that will give you a percentage. So you will express it as, for example, 10%, 15%. Okay, so that's your gross profit percentage. Then we can also do on our net profit percentage. Now, net profit percentage, you go to your income statement. You must look at your net profit after tax, or profit after tax. That's your net profit. And we're going to take that and divide it by our total sales times 100. And that will also give us then a percentage. So you'll express it as 5%, 6%, 20%, whatever the case may be. Then we have return on average owner's equity. Okay, so there we're going to take our net profits, and we're going to divide it by our average owner's equity. Okay, so when we talk about average, you will take the previous year's figure plus this year's figure and divide by 2. Okay, so if you say average owner's equity, it's this year's figure plus last year divided by 2. I'll try and write it here. So this year plus last year. Figure, and we take that and we divide it by 2. So whenever we use averages, that is what we're going to do. We take this year's figure plus last year's figure and divide it by 2. That will give us an average. Okay, then we go to our liquidity ratios. Liquidity refers to will you have enough cash to pay your expenses in the short run. In other words, will you have enough money to pay your wages and salaries? Will you have enough money to pay for stock, etc.? So the first ratio we're going to do is what is called our current ratio. So current ratio, we will go to our balance sheet and we will look at our current assets amount and we'll divide it by our current liabilities. So what this ratio means is if I liquidate all my current assets, in other words, the cash in my bank, I sell all my stock, I collect all the money from my debtors, will I be able to pay my current liabilities? That is my creditors and any other current liabilities that I may have. Now, this ratio must be more than 1. If it's not more than 1, you are in trouble. You cannot have more current liabilities than current assets. It means you're going to run into a cash flow problem and you won't be able to operate. Okay, but this is a ratio and it will be 3 to 1 or 2.5 to 1. It's not a percentage. So this ratio, the bigger it is, the better, the higher it is. In other words, if it's just 1.1 to 1, it's okay, but we want it like 3.1 or 4.1 to 1 or something like that. So the higher this ratio, the better for the company. Then we have what is called the acid test. Okay. Now the acid test is also called the quick ratio. The same ratio is a different test. I mean, sorry, same test, different name. So the acid test or quick ratio, what the formula for that is we're going to take our current assets from our balance sheet minus our inventory, and we're going to divide that by our current liabilities. Now, what this ratio means is if I take my current assets and I remove from there my inventory, so let's assume I cannot trade anymore. Something happened to my stock. It burnt out. The floods in KZN, all my stock ended up in the sea. Or with the riots then, the people stole all my stock. Then it says, okay, can you still pay your current liabilities? Okay. Now, this is a particularly difficult, the implication of this ratio, if you do not have at least one, then you are in serious trouble. If you can think about it, when we had the lockdown. So let's say you had a shop and you sold clothing. And not clothing that was now allowed by Minister Zuma. It was clothing that you were not allowed to operate. So what would have happened? You would have had to pay your rents. Okay. Let's say you had a restaurant, so you couldn't operate, but you had all the meats and all the vegetables and all the wine, everything that you had. You couldn't sell that. You couldn't get an income, but you had but you had all the expenses. So what inventory, I mean, what current assets do you have? Otherwise, you have cash and you have maybe some people that owe you money, some debtors, and you couldn't sell your stock. But then you still had to pay your rents, you still had to pay your wages, etc. So that is your asset test. So if you say you cannot operate anymore, so you cannot sell your inventory, will you be able to cover your current liabilities? Okay, so that is the asset test. Then we have what is called the average trade receivables collection period. Now, the average trade receivables, that is, again, what is trade receivables? That's the people that owe you money or your debtors. And the average, we take this year's figure plus last year's figure divided by 2. And that will give us the average receivables. And the collection period says how many days does it take us to collect the money from them. Now, when you give credit to customers, we normally give at least 30 days. Some people will give 60 days. They won't give longer than that. And you want to see how long it takes people to pay back the debt that they owe you. Now, in this ratio in particular, you want it to be as short as possible. In other words, you want it to be within 30 days or 30 days, but you definitely don't want it to be 90 days. Okay. The reason is when you sell on credit, you are financing your customers because they don't take out any money. They buy stock from you, which they sell. They get the money from that. And then they put it in the bank and some interest, and then eventually they pay you. So you are financing them. So you want them to pay you as quickly as possible. Welcome. So just hold on a moment, please. That's so we want them to pay us as quickly as possible. And you certainly, as I say, you don't want it to be 90 days and 120 days, because the longer it takes them to pay you, the probably that they will go insolvent and they won't be able to pay you and you'll have to write off a bad debt. Okay, so you don't want that to happen, so you want them to pay you as quickly as possible. Okay, we divided by credit sales. So you can't use the total sales figure. We're going to use the credit sales only, okay? Because your cash sales is not what you have to collect. You only collect your credit sales. Please excuse me a moment. Okay, sorry about that. I'm sure you all have families, and this is my granddaughter at my door knocking, and I just had to take her to her mother quickly. Okay, so we're going to look at the next one is the average trade payables. Settlement period, that means how long it takes us to pay our suppliers, our creditors. So again, we're going to take our average trade payables. So we're going to look at our balance sheet. We're going to say, what's our trade payables this year? We're going to add last year's figure to that, divided the result by 2. That'll give us the average trade payables. And then we divide it by our credit purchases. Okay? So we want to see how much of our purchases was on credit. And then we're going to multiply the result by 365, and that will give us the number of days it's taken us to pay our creditors. Now, with the accounts receivable, trade receivables, we want to collect it as quickly as possible. With the trade payables, the people we owe money to, we want to pay it as long as possible, okay? Because they give us 30 days to pay. Some will give us 60 days to pay. Now, we don't want to pay them in 10 days. They give us 30 days, we'd rather pay them in 30 days. Simply because if you think about it, if I have to pay the money, I pay it now immediately instead of 30 days, I could have put that 30 days, that money in the bank for 30 days, and I could have earned interest on that. Okay, then we have our average inventory turnover. What we mean by that is how many times a year do I turn my inventory? Okay, so if you think about it, let's say I sell baked beans, tins of baked beans. Now the question is, how often do I replace that particular tin of baked beans that I have on my shelf? Okay, do I replace it 6 times a year, which means I sell 1 tin of baked beans every 2 months? Or do I replace it 24 times, which means I sell it every half a month? So that is the what this ratio means, the average inventory turnover. Now, again, this ratio, we want this to be as quickly as possible. In other words, we don't want it 5 times a year, we want it 10 times, 15 times a year. Okay, so you want to turn it as quickly as possible. However, one must be careful with this ratio, depending on the type of industry you are in. This ratio could be 3 times a year, and others should be 20 times a year. For example, if you think, if you are in the luxury, you're a car dealership and you deal in luxury vehicles, okay, then you're probably going to sell the luxury vehicle that you have in stock every 6 months. So your inventory turnover will be twice a year, or 2 times a year. But if you own a fruit and veg or a Food Lovers Market store, you can think that fresh produce you get in, the fresh tomatoes you get in, you'll have to sell it at least once a week. So in that case, your turnover is going to be 52 times a year. So one must be very careful if you just look at a ratio like this to say it's good or bad, because it would be dependent on the industry you are in. Okay, so those are the basic formulas. So let's have a look at this particular income statement. Okay, this is from example 2E. That's in your textbook on page 32. So I want to show you how the ratios, how we got to these ratios based on this information. There's your income statement. There's your sales, 390. There's your cost of sales of 280. You have a gross profit of 110. 390 minus 280. We add other income as 3. We have expenses of 81. And we have a profit of 32. So that's a given income statement. Then we've got a balance sheet. There's 2004 here and that 2003. I've just put, I didn't put the whole 2003, it's just for comparative figures. Unfortunately, when I copied, I lost the last couple of lines, but we have the textbook, so you have it in front of you. Okay, so there's our balance sheet. There's our assets, our non-current assets. That's 550 land and buildings and vehicles carry value. You add it together, it gives you the 583. Your current assets is 107, which is made up of 58 plus 49. And our total assets is then the 583 plus the 107 is 690. Okay, I've just put the previous year's inventory there, 33. Trade receivables, 31. Then we have our owner's equity of 273, our non-current liabilities, long-term loan 125, and mortgage loan of 250. And current liabilities, we have the 42, which is made up of trade payables, 22, and then there's a 3 for a SARS VAT payment that we still need to do. And a bank, 17 VAT and 3 for an overdraft. And there's the comparative figure. So let's look at the ratios, how we calculate the ratios. If we look at our gross profit percentage, okay, we said the formula is our gross profit divided by our sales times 100. So let's go to our income statement. There's our gross profit 110 divided by our sales of 390 times 100. Okay. And that'll give you 28.21%. Then we get our net profit percentage. Again, it's our net profit divided by our sales times 100. So we'll go to our income statement. There's my net profit of 32 divided by my sales of 390 times 100. That gives us 8.21%. Okay. So let's go to the, if you look at the textbook page 33, you will see there is the prior years, we've got 28.21 now. The previous year was 29.36, and the year before was 33.47. So that's a downward trend, which is not good. You don't want a gross profit percentage that's decreasing. Okay. Now, this could be for several reasons. Now, this gross profit percentage is your gross profit divided by your sales. Now, but to get your gross profit, it's your sales less your cost of sales. So if this ratio is decreasing, it means that as a proportion, your cost of sales is increasing compared to your sales. Now, if your cost of sales is increasing, it can mean several things. Either you're buying obsolete, you've got obsolete stock, or you're buying more expensive than previously. So there are lots of reasons. So you'll have to always look why this is happening. The net profit percentage, if you look at the previous years, it was the previous year was 12.36, and the year before was 19%. So that's a huge drop from 19% to 8%. Okay. So you'll have to try and find out why this is happening. And unfortunately, they don't give us enough information on this income statement for us to find out why it is decreasing like that. Okay. Then we have the return on average owner's equity. So let's go to, we know the return, which is our profit, 32, which we have seen from our income statement. There's our 32. And we're going to divide that by the average owner's equity. So if we go to our balance sheet, there's our owner's equity, 273 this year and 209 the previous year. So what we're going to do is we're going to take the 273 plus the 209, and we're going to divide it by 2. So 32 divided by that value there, multiplied by 100, and that gives us 13.28%. Okay, now, again, that 13.28% means nothing on its own. But if we look at the previous year's figures, it was 30% and 65%. Now, if you were an investor in this company that had return on average owner's equity of 65% and is now down to 13%, then you won't be happy with the performance of this company. Okay, so that is the return on average owner's equity. Any questions on these ratios up to here? Is it clear for everyone?
Yes, it's clear for now.
Okay. Okay, fine. Okay, let's go to our current ratio, which is our current assets over current liabilities. So we'll go to our balance sheet. There's our current assets, 107. 107 divided by our current liabilities of 42. Remember, I said it's a ratio. 107 divided by 42 is 2.55 to 1. So it means for every 1 rand of liabilities, I've got 2.55 rand of current assets to cover it. That one. Okay, so if we look at the ratios in the textbook, it was 2.11 the previous year and 1.51 the year before that. So in this particular example, it is now improved. So you have got more money to cover your current liabilities than before. Let's go to our asset test. That's my inventory. Sorry, current assets minus my inventory. We'll go to our balance sheet. There's our 107 minus my inventory of 58. 107 minus 58 divided by current liabilities of 42, and that's 1.1721. Okay. If you look at the previous year's figures in the textbook, you will see it was 1.17 the year before, and before there was 1.07. So it has stayed the same for the last 2 years, but at least if you have a ratio of more than 1, it is quite acceptable. If it's less than 1, you should be worried about it. Okay, then we go and have a look at average trade receivables turnover collection period. So we're going to go to our trade receivables. 49 plus the previous year 31, so 49 plus 31 is 80. My arithmetic is correct. Divided by 2, that's 40. Divided by, okay, now this is, you must always look at the notes that they give. Okay, so if you go to that on page 33 at the top, we're looking, the formula is our average trade receivables over credit sales. Okay, so if you look at the page 33, the notes at the top there, the second bullet point, says 80% of all our sales are on credit. So we said our sales, our income statement is 390, but 80% is on credit. So we're going to multiply that by 80%. Okay, so 390 times 80. It'll be 40 divided by 390 times 80 times 365, and that gives us 46.79 days. Okay. Now, if we look at the previous year, was 20 on the top of page 35, it was 29.71 days, and the year before was 27.93 days. So it was fine the 2 prior years, but this year it's gone to 46.79 days. Now, it means you're collecting your money much slower. Okay, so management will have to give attention to this and make sure that you collect your money quicker, because there is a risk of bad debt. If the longer it takes for people to pay, it will result in bad debt. Okay. Then we go to our average trade payable settlement period. Okay, now before we continue with that, it's your average trade payables divided by your cost of sales. If we look at the top page 33, the bullet points under the notes, the last one, it's 75% of purchases are on credit, and purchases equals 60% of cost of sales. Okay, so you'll have to go to your income statement. There's our cost of sales, 280. Now, of that 280, 60% of that is purchases. Okay? 280, 60% is purchases. And of this purchases of 60%, 75% is on credit. So you're going to take 280, multiply by 60%, multiply by 75%. Okay? And that will give us an average of 62.28 days that is taking us to pay our suppliers. Okay, and if you look at the page 35, where they give you the prior year figures, the previous year was 50.69 days, and the year before was 51.01 days. So it's taking you longer to pay your creditors, and this would indicate that you have running into some liquidity problem, that you cannot pay them quick enough. Okay, but it is because you are collecting your money much slower. Remember that if you look at your current assets, it's cash plus your debtors and your stock. Now, you sell your stock, and that becomes a debtor, but you need your money from your debtors to pay your creditors. So the longer it takes you to collect your money from your debtors, the longer it's going to take you to pay your creditors. And that means you're running into a liquidity problem, cash flow problem. So this is what this ratio is indicating. Okay. So the company must be you must look at why this is happening. Okay, then we've got our average inventory turnover. Okay. So the ratio for that is our cost of sales divided by average inventory. So you'll go to your income statement. So income statement, cost of sales to 80, and our inventory on our balance sheet, the average between 58 and 33. So 280 divided by 58 plus 33 divided by 2, and that gives you 6.15 times. So this tells you how long it takes you to turn your stock. And if we look at previous years, the previous year it was 12 times, and the year before there was 16.7 times. So it is now less than half of what it was, twice as slow as it was 2 years before. Now that is of serious concern. It means either you've got the wrong stock, obsolete stock, or you've bought too much stock. Okay, so that is the reason why this is why it's taking so long to turn your stock. Okay, so those are the basic ratios. Then when we look at your financial statements, the question of dividends. Dividends are distributed to your shareholders. Remember, for debt money that you borrow, you pay interest. For money that you use from your shareholders, you have to pay them dividends. Okay, so that's how it distributes the money to your shareholders. And we take a portion of your profit and you pay it out as dividends to your shareholders. On the other hand, You can't pay out all your profit to your shareholders because then you won't be able to run your company or expand the company. So you're going to keep some of your profit in the company so that you can expand. Okay. Now, these sort of dividend policies are determined by the board of directors well in advance. So when it happens that normally companies will say, well, let's, for argument's sake, we will pay out 60% of our profit in dividends and we'll retain 40%. And that is what they will, how they will do. So you keep some of the profit so you can expand the business. Okay, so I want us to go to activity 2F. The wrong one here. I was going to get the right one because there's something not right. Okay, let's go to activity 2G, not 2F, 2G. That is on page 36. Okay, and we're going to have a look at these ratios that we have to do there. Okay. Okay, so let's have a look at, we're going to calculate our various ratios. So if you take, we're going to first look at our gross profit margin. So we'll get the formulas here. So if we look at our gross profit margin, now, when we had the first example there, it was very straightforward, the way they set it out, but now it's a bit more complicated. So from our general ledger, if you look at page 36, they've given us the trading account and then our profit and loss account. Okay, so if you go the first ratio of gross profit percentage, you will look at the top section at your trading account. Okay. And you will see there your profit and loss. So your gross profit is the 338, which is profit and loss, the second entry there, 338880. So that is your gross profit. Okay, and your total sales will be the 744. If you look at the sales at the top right, the 744,000. So it will be 388,880 divided by 744,000, and that'll give you a 45.55%. Okay, I'm just giving you the current year. You will have to, in your own time, work through the other 2 years and see if you get the answers to that. Okay, as long as I'm just trying to explain to you where to get the figures from. Okay. If we then look at our net profit margin, okay, so net profit divided by our sales. So we will go to, if you look at your profit and loss account, we go to the bottom where it says capital net profit in brackets, the 8542. So 80,542.96 cents, divide that by our sales of 744,000. Okay, so that's how we get that particular one. Okay. If we then look at our return on average owner's equity, our net profit we know now is 8542. Okay. However, if we now want to find out our average owner's equity, so this is a bit more complicated and I'll have to explain to you. If you go to page 37, under equity and liabilities, you will see there are three columns to that balance sheet. The one is your cost price, the one says accumulated depreciation, one says carry value. So if you look at owner's equity in the middle of that table, balance sheet, you're going to see there's an owner's equity total of 653,137.76. So that 653,137.76 is the current year's equity. If you go to the column next to it, it says capital of 582,514.80 plus your net profit less your drawings. Now, the way this is set out, that capital is the previous year's owner's equity amount. Then they add the profit. If you go to your income statement on the left there, you see your net profit of 8542. It's reflected there, 8542. There's drawings, but drawings come from another account. So to get your average, you're going to take that 582,514 plus the 653,137 and divide it by 2. Okay, are you all clear where that figure comes from? It's not, sometimes they will give you nice figures, comparative figures of previous years. In this particular case, you actually have to work it out on the balance sheet based on that owner's equity. It shows the previous capital plus profit and less drawings. Okay. Let's have a look at the other ratios. Current ratio, current assets minus current liabilities. The current assets is 47,035 divided by current liabilities. Go to your balance sheet, the bottom there, it's 16,552.20. So you'll take the 47,035.96 divided by 16,552.20, and that will give us 2.84 to 1, which means you've got R2.84 for every R1 of debt, of equity, current liabilities that you have, current liabilities. Okay. If we look at our asset test, which is our current assets, we go to our current assets, 47,035, less our inventory of 25,890, and we divide that by our current liability of 16,552. That will give you a ratio of 1.21 to 1.28 to 1. But let's have a look at our average trade receivables. Okay. Average trade receivables. So we will have to go and see where we're going to find this. So let's go to our current assets. We see trade receivables is 21,145.96. But now we've got to go and find out where do we get the previous year's figures. So we'll have to go to our notes. Okay. And then if you look at under the notes, the bullet points 1, 2, 3, 4, 5, they say the net trade receivables balance at 31 August the previous year was 22,424. So we're going to take that 22,424 plus the current trade receivables 21,145. And we can divide that by 2. And then we're going to look at our credit sales. Okay. So credit sales, we've got, if you look at your sales figure on the income statement on page 36 at the top there, sales, of 744,000. And then we have to look at, we want to know what credit sales are. So we've got to go look and say on the bullet points. Look at the second bullet point, they say 55% of all sales are on credit. So we're going to take 55% of our 744,000. And that'll give us our credit sales. We then will get, so the calculation will be 21,145 plus 22,424 divided by 2 to give us our average. And we're going to divide that by 55% of 744,000 times 365, and that'll give us 19.43 days. Okay. Average trade payables. So we've got to look at average trade payables. We can go to our balance sheet, and they said trade payables is 12,261. And now we have to look at the previous year. And the second last bullet point under the notes, it says net trade payables was 18,222. So we're going to take the 18,222 plus the 12,261 and divide that by 2. And we've got to divide that by our credit purchases. Okay. The credit purchases, if we look at the second bullet point under the notes, where it says assume 365-day years, 55% of all sales are on credit. Then it says credit purchases for the year, previous year, of current year rather, is 171,500. So they've given us our credit purchases. We're going to take our average trade payables, 12,261 plus the 18,222, and we're going to divide that by 2, and then we divide that answer by 171,500, and that gives us 32.44 days. Okay. So these ratios, you must just really look where to get the figures from, and you have to have a look at the notes because the notes will explain in more detail. Okay. The example we did early on, if you look at that example, they show you 3-4 years, or rather 3 years figures. In this case, they don't show us the previous year's figures, and then you'll have to pick it up from the notes. Okay. Then we have an average inventory turnover, our cost of sales. We know where our cost of sales is. It's on your trading account. Cost of sales is 405,120, and we're going to divide that by our average inventory. Okay, and if we look at our current assets, our inventory is 25,890, and if you look at the notes below that, the last bullet point, they say the trading inventory on hand was 42,300. So we're going to take the 42,300 plus the trading inventory of 25,890, add them together, divide by 2, and we're going to divide that into our cost of sales. And that will give us 11.88 times. That's how often we turn our inventory. Okay, so I want you for homework for next week, I want you to do the calculation for the previous 2 for the example we did. There was example 2E. I want you to calculate the previous year's figures for that. Okay. And then we've done activity 2G. We can also try and do activity 2H. Okay. And that will, so that you get some more exercises on this. So I want you to do that, and I want you to have a look at the comments that is made. There in the solutions at the back of the book where they give you the answers, where it explains the movement in the ratios over time to say whether it's good or bad. I will next week. I'm just going to give some notes on ratios, on comments on how you can comment on it, and what is good or what are bad ratios. So I will make that available as well to you. Okay. Okay, so that is what I've got for you for this evening. I don't know if you have any questions on these ratios. One will just have to practice them. Okay, the next week we're going to be look at depreciation, disposal of assets. We're going to look at what is depreciation, and how what disposal of assets. In other words, you have got a vehicle you want to sell, and we're going to look at what the effect the depreciation have on the disposal of the assets. Okay. Any questions? Otherwise, we just say goodbye.
No questions from my side. Oh, thank you.
Thank you. Okay, have a good evening. I hope you survived load shedding for tonight.
Thank you.
Thank you.
Bye.
Okay. Goodbye.
Bye.